pieces to touch on today. There's a few bits and pieces that we haven't talked about before, so we'll cover them. We've got one trade setup to look at, and we'll touch again on the delta buckets since we've covered this subject in quite extensive detail today. I've traded these delta buckets that I've taken screenshots of, so you can see just from the trades that I've taken today on the delta buckets alone, I've traded up to 5 contracts. It's on the NASDAQ and on oil only, and it's the ones I've taken screenshots of, nothing else. And we've put together $8,939, 8,939 in profits on the delta bucket trades on their own. Now that's not bad. As I said, it's not trying to manage out any big positions. It's just getting stops at break even and taking a bit of profit if I get a chance during commentary and on my own stuff. So I'm not unhappy with that outcome based on the delta buckets. Now, what are delta buckets? A delta bucket is basically a bucket of delta, surprisingly enough. I suppose it's in the name, isn't it? It's in the title. And the whole point about delta buckets is it's just the change in skew. So when we think about the change in skew, you know, when I draw, for example, if I was to draw a couple of charts here, you would be able to give me a fair idea about what the chart's doing at any particular time by simply drawing a sequence and a time sequence of skews. So if this is the time sequence of skews here, and I draw the first skew, you can probably already tell me that your idea is you're going to be a seller. This is quite clearly going to be a short sell, right? But obviously, as the skew changes over time sequence, you can see that perhaps buying into the low makes a lot of sense. So you can almost tell almost immediately that you're going to be selling and maybe not selling so much, and then perhaps even reversing into a possible buy trade would make a lot of sense if you're getting the right pricing in those areas. Now, why is that the case? Well, it's very, very simple. It's all to do with delta hedging. Nothing to do with your deltas that you see on the screens, this volume delta. It's got nothing to do with that delta. So unfortunately, the wording is the same, but it's got nothing to do with delta you see on your screens. This is delta pricing. So obviously what this means is that this brings in a delta hedge because at the moment the price of, so the way you look at these generally as a rule is you draw a middle price, okay, and you draw it through this area here, right? You just draw a middle price. And the basic rule of thumb with these is this is what your option delta looks like. In other words, you're looking at the 25 buckets. The 25 buckets reside on the outside of this price line here. So this is where the 25 buckets reside. And it's a bucket which normally consists of like the 20s, the 25s, the 30s. In other words, the out of the money calls and the out of the money puts. So obviously this is an out of the money put in here, right? OTM put. And this is an OTM call. Does everybody understand that? And this is an ATM. So this is what we're looking at. So ATM means at the money. OTM means out of the money. And obviously that means that this is currently the price below. So if this was the price scale, for argument's sake, this would be, for argument's sake, this would be 2,000. I'll make it 200 because it's not going to fit in. So if that's 200, this would maybe be the 210 calls, and this would be the 190 puts, yeah? So the current price on this would be 200, okay? So now we can recognize the difference between these. So if this is the 200 at the monies, and out of the money call is 210s, and out of the money put is 190s. So we can start recognizing this as a price area. Why not the 20s or the 30s? It's just because 25 has a bit of volume in it. The 25 delta. There's no real reason, Miguel. It's just because if you go any further than 25 out, the volumes disappear into nothing. You know, so it's the kind of last outside volume it's the last outside strikes that have any real volume on a daily basis. So that's why they do the 25. So it's also got enough skew in it that it gives you the full size curve. You know, so you get to see this. It's like looking at the options, the bond curve. If you put in a full curve, then you get a lot of curve for your money, right? If I put in, for example, oil on a calendar spread, if you use calendar 1 and calendar 2, it's a bit noisy. If I use calendar 1 and calendar December, we're getting more calendar, so we get more read off the calendar. Do you know what I mean? So therefore, if I put in more deltas, I get a bigger read about that overall shape that's forming from the delta skew. So when we see this, we can start recognizing it. Now, there's obviously this here, which is a bearish skew. It's a starting point. We don't know whether it's got more bearish or less bearish when it's came into this area, but it is definitely a bearish skew. The bigger the bearish skew, the bigger the sell opportunity. Why? Well, because if there's a bearish skew coming in, as I said, the delta is obviously getting higher, the implied volatility, the pricing is going higher, then obviously what happens is that they have to sell more product to cover. So in other words, this is all about that delta hedging. To achieve delta neutral, they have to sell product, right? They have to sell underlying product. So to get a delta neutral position in that type of skew, you've got to be short product. Now, obviously, if we then move to the right, that delta skew is getting less, right? It's actually getting less. It's still negative, but it's getting less. So what that means is they can actually buy back some of that product. They don't need as much. But it's still bearish, but they can still buy back some, which means that the price may start rolling back to the upside. And obviously, again, they can buy back some more here. So this is why, whilst it might be negative, if the negative is getting less negative, it can be bullish at bottom edges. And we really do prefer to be bullish at bottom edges, not certainly at top edges in these types of narratives. So there's two pieces of information. How negative is it? And we'll see what happens. Sorry, there's been news just coming through there, guys, from Rafah and from the Israelis and from the Iranians. I was just watching just in case we got anything interesting flying off there. So I was just paying attention to that. Okay, so when we start seeing these as things, when we start seeing these as stories, you'll probably be aware that we've charted since about 12 o'clock, we've charted every single delta storyline. And as you can see from the delta storylines, you can see this skew storyline here, the 25 risk reversal narratives. You can see that this was bearish. It's been bearish since the get-go today. Now, one of the things we can recognize as we come back up, the previous high here was 6, and then all of a sudden it jumped to 8. See that? So this high was 6, and then it jumps to -8. Well, I'm going to sell any uptick at that stage. And when it got down into the bottom edge, it went from 7s back down to 6s. So I'm going to buy back some of my product. And the price goes back up. As we reach up into the top edge, it doesn't go to 8, it goes up to 9.7. And then 8.5, and then 8.8, and then 8.9. This is a very bearish top edge. Very bearish top edge. So in other words, it's a straight line, but yet the numbers, the skew is even more bearish. So in other words, they'll be using this top edge liquidity as basically just a scoop to get as much short positioning as they possibly can in the underlying product. So when I see these sweeps into the top edges with that incredibly bearish storyline, I'm ready to do a lot of business on the short sell into these highs. A lot of business. As the price peels away from it, you can see obviously it drops, and that's natural. It should drop. The lower price goes, the more chance that buyers will come in. Of course, it's supply-demand economics. One of the things you don't want to see is you don't want to see it dropping and then rising at the same price. So it went down to minus 6.0, and then it went back to minus 7.0. So therefore, at that stage, you'll be saying to yourself, well, they're definitely going to go for a sell-side press at this stage. And the sell-side press came in, and we got a very, very big rip to the downside. Similar thing happened here. We went from 6.3 to 7.7. I did a bit of selling, got some money. And then, of course, we started to see that commercial buyer coming. And you might have remembered that I tweeted it out. There's a commercial buyer. For the first time today, a commercial buyer starting to show up. And that was the end of my down move. Just as soon as we said that, no sooner had we said that, but it went from 7 to just minus 4. Well, minus 4 was one of the lowest numbers we've had today. Certainly the lowest number we've had during this period that we've been taking screenshots, right? So minus 4 is very bullish, and look at what happens. So you could have taken that read and says, well, we went from minus 7.7 to minus 4. I'm going to go long here and move. Oh, what a great pop you got, right? At the top edge, you can see the normal that we had before was at minus 9. Well, it's only minus 5.8 and minus 6.5. It's a lot less than it was before, isn't it? Now, it did go from minus 5.8 to minus 6.5, so you're probably still looking at that and saying I should be short. So you can simply get back into that and start working back round into a bit of short business if you wish. And then as we came away, you can see we went from minus 6 to minus 6 to minus 2 into this buy area here. What? So there's a really, really strong opportunity to maybe start picking up some buys at that opportunity. However, it went from minus 2 back up to minus 7 almost immediately. So you're now looking at that and saying, wow, okay, so the sellers, this guy here found no buyers, and they've gone very heavy short. They went from minus 6 to minus 7 at the same price. This is very bearish again. Very bearish. Just trading these blocks, just these blocks and nothing else at all. You know, these trades have made $9,000 on up to 5 contracts. Now, we haven't always had 5 contracts, but that's up to 5 contracts. These trades have made $9,000. Currently, the oil is at minus 5. So obviously, it's peeled away quite substantially from the previous minus 7. And obviously, that means that you're probably going to want to book some monies. Minus 5 is quite subdued, I suppose, in overall terms. It's quite quiet. And based on the minus 5, you'd imagine that there's not going to be a huge big sell-off into the lows unless all of a sudden you start seeing it picking up from minus 5 to minus 7 again, like we did in here. In which case, you might see the price just jamming into the bottom edge and then going strongly bid or whatever. So if it can stay with this narrative at the moment, of course, then we're in pretty good shape. So this is all these buckets are. This is all we're getting from these buckets. But my goodness, has it provided us with a lot of insight? Of course it has. Now, the downside is you're having to do this all manually at this point. And, the idea is that ultimately this was the original delta buckets that I proposed to. This was the original delta buckets project that I proposed to David many years ago, and it was just very, very cumbersome. It was very clunky. There wasn't an awful lot of opportunity for us to do much with it. But nonetheless, you can see that just even these little ideas can provide us with some very, very interesting stories. It's not ideal, but it's better than nothing. It's institutional pricing, after all. It is the reality of how these trades are starting to skew out. And when we see it, it's provided us with some of the biggest trades of the day. Look at the biggest reads. This jump from 5s and 6s to 8s and then jumping up to 9s, it's given us that massive sell on oil, didn't it? Massive sell in oil. And that massive sell in oil was when 85.30s to 84.10s for $1,200 profit per contract. That is a massive sell. Take a look at the biggest trade on the NASDAQ today. The biggest trade on the NASDAQ was when it went into this top edge here, wasn't it? So into this top edge retest, we went from 1.9, 1.9, and suddenly we jumped to 3. As we jumped to 3, there was no choice but to get short sell. Same happened into this top edge. We went 2.7 to 2.4 to 2.5 and then jumped to 2.8. This is going to run the bottom edges again, isn't it, at 2.8? It's going to run the bottom edges without any question. And it did run the bottom edges. You got this brilliant rip to the downside, and we got a very, very big profit out of that short sell. Oopsies. So we can see that this is something that we pay attention to. This is a real something. It's always been paid attention to by institutions, of course, because they're getting real-time updates on this. You know, what we see on our screens isn't the same as what you're getting here, but this is still pretty good. It's not that clunky to do as a 5-minute refresh, as a 5-minute narrative, just to remind yourself what is available in terms of how bullish or bearish these skews are. If I don't know that, it's kind of a bit limiting, isn't it? Now, we can see this in some indicators. We can see this in, for example, the gamma line. How pricey is the gamma line reflects the skew. Of course, if the skew is getting more skewed, the gamma line will start be getting steeper. If, however, that is something other than equities, then that's not much use. Like oil, gold, bonds, for example, you're not getting that same quality of information. So this is very, very powerful. But remember, it's not a trade everywhere. The idea is very, very straightforward. The skew should just adjust as the price drops. So in a normal supply-demand economics, think about how you would price the market skew in terms of your delta hedging. In normal supply-demand economics, one would imagine that if this was the normal range and this was accepted that this is how the market would trade, you'd imagine that as the price hits the middle price area here, your skew would be 0, right? The idea is your skew would be 0, and there wouldn't be any particular advantage to this. Now, as the price starts dropping down, you'd imagine you'd start skewing to the positive, wouldn't you? And the more you skew to the positive, the more opportunity you've got of maybe buying some business here, right? And as it comes off, you start skewing it back out again, and you say, well, we're now bullish, but it's getting less bullish. As it goes higher, we hit back into the 0 point, and guess what happens? We start skewing it on the other side. So as we start going above the top edges here, we start saying, right, we're going to start skewing this to the upside now. And this is the normal, isn't it? This would be a normal view of how the market would start to skew in terms of a normal market rotation. But what happens if this happens? What happens if we see a situation whereby the price comes back down to here and it holds around this area, and then all of a sudden, instead of being at 0, what happens if the skew here is -3? How's your view changed? It just became very bearish, haven't you? So with a skew of -3, you're now very bearish that this market is now going to collapse through the bottom edges. And unless the skew was able to be recovered, there's a very good chance that that's now going to press through to the lowest lows. And that's what we've seen all day today, haven't we? If you just go back again to that oil storyline, take a look, and you won't be surprised at these. These have all been updated with you in real time. And again, it's okay seeing this getting more negative at the top edge, but look at what happened in here where we went from 6.6, 6.0s, all of a sudden we spiked back up to 7.0s. And as we spike back up to 7.0s in an area that we should be at 6s, then I'm going to be selling into this. The fact that we got 8 on this uptick here, lower than the previous highs, And then 7s in this area here, that's not normal. That's way above normal. So because of that's way above normal, I'm now thinking that the price has further to go, and I was 100% accurate. I was 100% right. It had further to go. And we made some easy money, very easy money on the short sell. So we can see again this storyline, and as Theo's rightly mentioning, there's a couple of very good sells here, but that was still being led by the market maker. But it was a parallel shift here. But then all of a sudden, the algorithms took control here on this big red candle. And with this big algorithm taking control, this pullback was like a gift, wasn't it? That's the kind of trade that when we get into the alpha accelerator, when you start to recognize that idea, that's like the let's get as heavy into that short sell as we possibly can do, because this is going to make us a lot of money. Sell side 84.80s eventually trades 84.10s, and we make $700 on that momentum sell, Theo. It was absolutely brutal. So this is what they call the delta buckets. This is a professional trading process that is very awkward in the retail space because of the way that you've got to present and update these data points at this point. And it's obviously a very, very, very successful subject. It's something that, perhaps has been purposely kept from the retail trading brigade for a long time. I did, as I said, launch this project many years ago with David. And, and as I said, it was clumsy and it was costing David money. And there wasn't a lot of interest at that stage from the class, because people were still trying to figure out what a candlestick and a futures contract was. So at that stage, it was quite maybe too early. It was maybe a bit too advanced, and it never really gained any traction. But perhaps now, a lot of people starting to now see that this is the kind of information in real time that can generate some incredible tradable opportunities. Now, I don't know, does anybody from that little screenshot there get any sense that this has a value for them? I think it would be incredibly difficult not to have that conclusion. You saw, for example, that exit price at the bottom edge at -5. To go from -7 to -5 back into a bottom edge, there's a very high probability that that price is going to bounce at that stage, and it did bounce at that stage. So this becomes a very, very influential piece of information in and around these trade areas. It is a real thing. It is a very, very, very real thing. This is something that we have traded with for many decades in the institutional space. And a lot of people don't know that this even exists as a thing. You can see, for example, you might be saying, why is this not a big sell on oil here? Well, I'll show you why it's not a big sell. Let me just show you the current bucket on this. And there's the current bucket there. It's -2. It's went from -5 to -2 in that up candle. That's a big drop, isn't it? A very big drop again. This is the second time we've dropped to -2 into the same price area here. See that? -2.8, -2.1, and it's jamming this price into this bottom edges here, isn't it? So now you're wanting to see this top line reducing as well. Instead of it spiking to 7, it'd be nice to see this staying at 2, which would allow you to now buy dips, isn't it? Instead of buying bottom edges, any type of dip would be a buyable opportunity at that stage to maybe take the market bid away from this price line. So I'd like to see it retesting and it becoming positive. That would be nice. And if it did that for this afternoon, we might find ourselves in a very big buy trade for the afternoon session 1. So when we see this as a process, when we see this idea eventually developing and evolving, you can see the biggest trades in, right through the entire day. You can see the biggest trades. The biggest trade was this sell at 9 here, wasn't it? That was the biggest trade of the day, bar none. That sell at 9 in this top edge here. And that's the outcome you got from that trade. It was worth over $1,000 of profit on that 9 right there. Over $1,000 on the oil. And that's the key to this, isn't it? The idea that these really are the big ones, the big story, the biggest stories of the day. That sell that we got in the NASDAQ earlier, that the biggest number of the day we saw was what number? 3. That was the biggest sell we've had today. That swing away from that top edge was that 3 there. We had a 2.8 here, the second biggest number of the day, and that swing away from the top edge was perfect. Absolutely brutal how good it was. That's the point. They're bloody good. That's the point we're making. They are very, very good. Now, if you take a look at the bottom edge of this NASDAQ, it probably won't surprise you what's happening just now. So here's a screenshot of the most recent. Let's paste this onto the screen. There it is there. Take a look at the screenshot. Look at what's happened to the bottom edge here. You see it? See what's happened to the bottom edge? It's not my numbers. They're not my numbers. That's the point. These are the market makers' numbers. So you can see it's went from 2.3 to 1.6 to 1.0. You can see that as it's went from 2.3 to 1.0, it's been very easy for this market to catch a bid away from this bottom edge, hasn't it? Very easy to catch a bid away from the bottom edge. And you can see the price is now riding around quite nicely. Now, if it jumps back up to 3 at the top edge, then that's not good. But the chances are it's not going to jump up to 3 because this was still 2.7. You know, the bottom edge, it was still very bearish. The top edge, it was even more bearish, and it became easy to sell it. Bottom edge is now bullish. If the top edge retests here are bullish, then this price has a very good chance of popping to the upside. That is the delta buckets. That's the delta buckets. Yeah. And the bigger the number or lower the number, the better. The bigger the change, the better. Why? Because there's more positions to trade with. There's more positions to change. So if the number goes from 1.6 to 1.0 or goes from -2 to 1, then they don't need to hold shorts. That means something. They can buy back a lot of shares to go delta neutral. And if they're going to buy back shares, they're going to buy them back on dips. And if they're going to buy them back on dips, you can start bidding into the dips and taking the bid back into that bit of business there, and the price goes back up. The delta buckets. Next up, we'll talk about CESI or CESI or CESI. We'll talk about that next. So give us 60 seconds, guys, and then we'll talk about fundamentals. What series of options, Michael? The shortest duration options. Because if you're trading on it, well, it depends what time of trade you're doing. I mean, if you're doing a long-term swing trade that's going to last days and weeks, then you would do longer-term options. But if you're trying to day trade, you would be trading short-term. You'd trade the shortest duration ones because they're going to be the most active.